Bond market total returns will likely come in at the low end of their mid to high single-digit return forecast. The increase in Treasury supply proved more troublesome than expected and pushed the 10-year Treasury yield up to 3.7%, up by 1.5 percentage points since the start of the year. Even though Treasury yields have increased, corporate yields are actually lower so far this year. The yield spread narrowing among corporate bonds, shown here in the chart, reflecting the improvement in credit sectors, exceeded our expectations as investors moved quickly from lower-yielding cash and treasuries to the better opportunities. The contraction in yield spreads among corporate debt has been dramatic. We expect it to continue, but at a more gradual pace. One reason we expect yield spread contraction to continue is that yield spreads at 2.5% above treasuries remain high compared to historical norms and high relative to prior crises. It's important to remember that non-financial issuers entered this credit crunch in better financial shape than they did in 2002. Credit spread levels still have room to contract further with additional value to be wrung out of financial issuers and BBB rated names. In addition, corporate bonds still provide investors a healthy yield advantage to other bond sectors, treasuries in particular. Speaking of room for improvement, this chart shows the percentage change from the peak in corporate bond yield spreads for the last 3 recessions. The first half has felt like, wow, that improvement came on fast. But as you can see, it's not much different than the prior cycles. Key point here is that credit quality improvements tend to be long-lasting. Corporations are actively engaged in deleveraging and balance sheet repair, and that can benefit bondholders for years. This chart also highlights the point made earlier of how improvement comes more gradually after the initial contraction. So, we continue to emphasize corporate bonds, both investment grade and high yield, in our model portfolios. As a result, we remain focused on intermediate bonds as we prefer sector exposure rather than making a bet on interest rates. A primary reason for this is the steep yield curve. A steep yield curve provides 2 benefits. 1, a lot of incremental yield for every year you extend maturity. 2, downside protection from rolling down the yield curve. While we do expect interest rates to increase, we expect it will be gradual over the remainder of the year and believe it does not offset the added yield benefits of a steep yield curve. Another area for room for improvement is the municipal bond market. Here we show average 10 and 30-year AAA municipal yields as a percentage of Treasury yields. The higher the percentage, or ratio, the cheaper municipals are relative to Treasuries, and vice versa. Valuations have improved a great deal in 2009, but remain high on a historical basis. The average AAA-rated municipal bond still yields more than the 30-year Treasury on an absolute basis. In essence, you're getting the tax benefit for free. Cheap valuations and favorable supply-demand balance has been the primary driver of performance so far in 2009. Both factors remain in place so that we expect further improvement but a more gradual pace going forward. The lack of municipal bond insurance will likely restrain municipal valuations reaching pre-crisis levels, but on a longer-term basis, the expiration of the Bush tax cuts in 2010 bodes well for further improvement in municipal valuations. So municipal bonds, like corporate bonds, look attractive, but there is still room for improvement in both of these sectors. And when referring to corporate bonds, we include credit-sensitive sectors such as preferred stocks and bank loans. Both remain cheaply valued, and we also find them attractive. Bond market risks? The primary risk is higher interest rates. We expect interest rates to move gradually higher. However, should interest rates rise faster than expected, either due to higher than expected inflation or the Fed hiking interest rates sooner than expected, then yield spread contraction from corporate bonds might not be enough to offset price declines from higher interest rates. If that occurs, then total returns might be lower than we expect. With regards to inflation, we believe it is too early for TIPS, Treasury Inflation Protected Securities. TIPS, like all treasuries, suffer from expensive valuations, and this is reflected in a low yield of 1.8%. As interest rates rise, the real yield will also rise, adversely affecting the performance of TIPS. We await a better entry point on TIPS. Breaking down our outlook. Stock market. Stocks' wild ride. Stocks had a wild ride in the first half of 2009. The stock market fell sharply during the first 2 months of the year and then rallied back to end the first half of the year with low to mid single-digit gains as economic conditions improved. On February 10th, the day Treasury Secretary Geithner disappointed the markets by unveiling an unclear financial stability plan, the stock market began a month-long 25% decline that culminated in a March 9 low of 676 for the S&P 500. Fortunately, the previously enacted policy actions began to bear fruit by early March. These actions were primarily focused on the hard-hit financial sector, which led the market in its journey lower. The stock market has gone from pricing in the Great Depression to a typical recession to what appears to be a recovery in just 5 months. Over the long term, earnings are the most important driver of stock market performance. Historically, stock market performance tracks expectations on earnings, with valuations having risen to about 15 times the consensus estimate for earnings per share for S&P 500 companies. Earnings growth is needed to power further gains. Whatever the level of earnings, analysts are predicting a big gain in 2010. Using the lowest median or highest of the Wall Street analyst estimates for each company in the S&P 500, earnings per share for S&P 500 companies is expected to rise 20 to 25% in 2010 from 2009. We believe the median forecast is now likely to be a reasonably accurate outlook for earnings. This is due in part to aggressive cost-cutting by companies. Even modest revenue growth, as GDP turns positive, can drive powerful earnings results. The 25% expected gain in earnings in 2010 implied in the consensus analyst estimates is in line with the typical rebound from prior recessions. Encouragingly, the best leading indicator for U.S. profits, the Purchasing Managers Index from the Institute for Supply Management, is moving higher. After bottoming at the end of last year, the ISM index has moved up steadily in the first half of 2009. This indicator bodes well for profit growth in the second half of 2009. How to invest for the second half of 2009.